Hi everyone, my name's Darryl Panes, CEO at As Good as Gold Australia, and today, once again, I'm joined by my brother Brian and partner at As Good as Gold.
Good afternoon, Darryl.
Brian, and today we interview John Adams, Chief Economist at As Good as Gold Australia. Good afternoon, John.
Good afternoon, Darryl and Brian.
Good afternoon, John.
Hey, John, 2019 has gone. We're now into 2020, a new year. 2019 was a very good year for precious metals. Gold up about just 18-20%, silver around the 30% mark. So silver outperformed gold last year, and there's a pretty good chance it'll do it again, and certainly with the information we're going to be sharing with you today. But a few things happened towards the end of the year that impacted on precious metals prices. The Iranian military leader, of course, was assassinated, and what we noticed was that precious metals went for a bit of a flip for 2 or 3 days.
Absolutely.
And then just went back to where they started from again.
Yeah.
I think what everyone needs to realise is that some of these isolated situations are going to cause movements in the precious metals market, but what impacts mostly on precious metals is increased debt. It's debt and money printing, and at the moment both are running rife. We're printing money through QE and repo markets at astronomical levels that we've never ever considered before, and that money printing machine just keeps on pushing out currency. And so we expect to see more of this in 2020, John, and to the extent that many experts, these are people that Brian and I know well and have been in the industry for a very long time, and they're in their own right very wealthy people. And they're suggesting to us now that we're on the verge of a major precious metals breakthrough once again. This has happened, major breakthroughs. It's happened twice since 1972 already. So even with the manipulation that's taking place and always has in the precious metal space with both gold and silver, they've both broken through 2 times in a very big way. So manipulation works until it doesn't. What I'd like to ask you, John, is this. If you could explain to how this manipulation process works, keeping in mind it has failed terribly on 2 occasions, and so it's got a pretty poor record. Why would governments continue, or central banks continue to use this process? Why do they do it? And how does it work?
What I want to do is, with your question, before I actually answer it, the first question I think we need to explain to our viewers and to Australians at large is to point out that the precious metal markets are heavily manipulated by central banks, by bullion banks, by these exchanges like the COMEX and the LBMA. A lot of Australians don't understand that when they look at gold or silver prices, that these are heavily manipulated prices. Now, over the Christmas break, I locked myself away and wrote a couple of articles about the silver market in particular, because that's one of the things I've been focused on in terms of my own buying, but also working with As Good as Gold Australia. So the article I wrote, and it's on my website, adamseconomics.com, and no doubt it'll be on the As Good as Gold website as well, is to prove the point that the silver market is manipulated. So it's much easier to prove the case that silver is manipulated compared to gold. But it was important that I do that, because anytime you talk about manipulation, the mainstream media, the commercial banks, politicians, etc., just say that all of this is conspiracy theory.
Sure.
It's not happening. But it's clear that that is definitely happening now. How do we know that the silver market? How do we know that it's manipulated and that the prices are rigged? So let me just take you back for a second. So in the last 40 years, since particularly if we look at prices, official prices recorded by the Perth Mint, the highest price for silver per ounce in Australian dollars is $44.82, and this was achieved on the 22nd of January 1980. So more than 40 years ago was the highest price ever achieved in terms of silver. Now today's price is $26 per ounce, roughly in Australian dollar terms. So in the course of 40 years, the price of silver has fallen about 42%. Now, you guys are much older than I am, but and you guys can talk to this a little bit more with more authority than I can. But if our viewers think about, well, what was the price of a house in 1980? What was the price of a car? What was the price of clothes and food and a whole bunch of things that you buy on a regular basis? A lot of people will say that prices throughout the Australian economy and the global economy have risen in 40 years because of inflation. So we've had constant inflation throughout the 1980s. We had a lot of inflation since the since the 1991 recession. We've had relatively low levels of inflation with the RBA taking up inflation targeting as part of their monetary policy framework. So we've had inflation was running about between 8 to 11% in the 1980s, and then 2 to 3% since the 1991 recession. So we've had massive amounts of inflation. Property prices are sky high. The share market's up significantly compared to 1980. Things are much more expensive, food, bread, milk, whatever. But yet silver is 42% down from the peak that it achieved in 1980. So the case is, well, why is that? And how does that make economic sense? And the reality is it doesn't make economic sense. So one of the things that I did in my article was to look at, well, how much money has been printed or created by the central bank and the commercial banks since 1980. And if you look at, so there's different ways to measure this, but one of the more reliable measures is what they call broad money, which is the broadest definition of money that the RBA measures. And so since 1980, the amount of broad money that's grown in the Australian economy has gone up 2,500%. So when we think about all the money printing and the credit creation and the debt that's happened in 40 years, it's gone up more than 2,500%, and yet silver prices are down 42%. So the only way that could even be logically possible is if the physical supply of silver has actually grown to an even greater extent compared to the amount of money that's being created by the RBA and the commercial banks. And because the broad money includes credit that's been created by the commercial banks as well as the central bank. So I looked at various measures in terms of what the world stockpile of silver is. And you look at different measurements. So the Silver Institute, gives you a bit of a figure for like 2018. And I've looked at various U.S. congressional reports to look at, well, what was the rough world supply of silver or stockpile of silver in the 1979-1980 range. And basically what I estimated was that the amount of available silver, above ground silver for use for trading in the global market rose only 92%. So you've had money printing increase 2,500%, and the physical supply stockpile of silver has only grown 92%, and yet the price of silver has never went above this 1980 level, and it's down 42%. Well, that makes no difference, because what we know about precious metals is that, and it's something that As Good as Gold has been preaching for a long time, is that gold and silver holds its value, and it's been holding its value for 5,000 years. So if we see this massive money printing, gold and silver should be at dramatically higher prices to reflect the loss in the purchasing power of the Australian dollar. So when I consider how much money has been created by the banking system, and then when I've factored in the growth of the supply of available above ground silver, the price that should be in the market today in Australian dollar terms is about $600 per ounce. $600 per ounce per silver, and yet the price today is only 26. So that says to me that the allegations that have been put forward by a whole host of people across the world, whether it's Bill Murphy from GATA, who you've interviewed in the past, whether it's David Morgan, whether it's people like Ted Butler, who's talked about the COMEX, etc. Eric Sprott has talked about manipulation as well. So when I've looked at this independently, the silver market clearly says that this phenomena that silver prices are 42% lower than 1980, it makes no economic sense. And that is such an important point to make for our viewers, because our viewers are very sensitive around price, and we have constant conversations with our customers about in terms of, well, what are prices likely to do? And a lot of our customers believe that gold and silver prices are traded in a free market with real buyers and sellers, and based on physical demand and supply of gold and silver. And the reality is that it's actually being controlled by these exchanges. Now, your question was, well, how do they do it? So with the LBMA and the COMEX, they use paper contracts. So in the futures market, you can put in a contract to buy gold and silver. You can put in a contract to sell gold and silver. And under the rules, you don't actually have to have the physical gold or the physical silver to basically facilitate a transaction in the futures market. I mean, you can actually settle these contracts in cash. And so what the riggers of the gold and silver markets have done is they are trading like huge volumes on a daily basis of gold and silver relative to the physical amount of silver that is actually available. And I'm pretty sure, and Brian can correct me if it's wrong, I think that in a previous interview, Brian referred to that, on some days, these exchanges are trading a year's worth of annual supply of gold or silver in a day's trading on these exchanges. And that basically makes no sense. I mean, if you're holding, hundreds of tons of gold or silver, you're not going to dump, all of these tons of silver on the market, because you're just going to, if you're going to sell it, you want to sell it slowly so you can actually maximize your price, and you don't want to push the price down. You don't want to push the price down too quickly, otherwise you're going to actually lose money. So the fact that you have an annual's, a year's worth of mining output traded on a daily basis, that makes no market sense or commercial sense. And so these exchanges that determine the international price, and again, I think that's an important point for our viewers to understand. The international price of gold and silver is not based in any physical market. It's actually based on these futures markets, which are effectively derivative contracts. So the derivatives set the price, and so that's how the manipulation works, by trading massive amounts of contracts relative to the available gold and silver that they actually have to actually settle these contracts if they were ever to take physical delivery. Now, your other question was, well, why are they doing it? So a lot of theories have been put forward in terms of why the central banks and the bullion banks and these exchanges would be rigging these prices. So a lot of reasons have been put forward over the years. The one that I find personally most convincing is the proposition that if gold and silver prices were going higher, this would be signaling that something was wrong in the financial system, that it would signal that something wrong with the monetary system and the value of money. And so in order to extend the life of the fiat currency system, they are keeping gold and silver prices suppressed so that they continue to keep the American dollar in particular, to keep that at the center of the monetary system. I'm pretty sure in a previous interview, Brian said that the average life of a fiat currency is about, correct me if I'm wrong, Brian, 40 years, 45 years?
It ranges between 40 to 50, and right now we're at 48.
We've had some very extreme money printing events, particularly after the 2008 GFC. So even though we're within that sort of range of the life cycle of a fiat currency, I have no doubt that if gold and silver prices were not manipulated, people around the world would have lost confidence in the American dollar much sooner, and the American dollar would have died by now. So 48 years in, how is the US dollar still the center of the monetary system? Gold and silver prices have been suppressed, and people have been led to believe that, or people have an artificial confidence in the American dollar and in other major currencies. And so that's why I think the whole suppression game has been in operation for several decades.
Yeah, well, you can see how at 48 years, there's a lot of controversy on the US dollar at the moment. China doesn't want to deal with it. Russia has got rid of all of its US dollar treasuries. So I think 48 years, we're very, very much closer around the corner, seeing some major changes. I'll follow on with a question, Darryl, if you finish there. Yep, I'll follow on with a question. Now, you've already made a comment, and there are a lot of people that make statements about the prices of silver and gold. I've never been the one to have exaggerations. I like to, bring the truth out there with what in my opinion is what I believe is a typical price what silver will go to over the next 1 to 2 years. But there was a comment made. It came past my desk the other day. With this manipulation, we still have forecasts like this one. They came across my desk from the name of Chris Vermeulen. I've listened to a couple of his reports. Sometimes they're okay, sometimes not. But he writes technical graphs traders. So he's a trader doing graphs. But saying that within the next 12 to 24 months, the price of silver may jump. May is the word here. May jump up to 500% from today's prices. And to $36 to $40 US before June, July 2020. Can you give me your thoughts on why Chris comes up with this prediction?
So, Brian, I would probably say a few things. The first thing is, you are definitely right. A lot of people in the last few years have made very big predictions about what gold and silver are going to be. And one of the interviews that you guys did in 2019 that caught my eye is when you interviewed Egon von Grays around, I think from memory, August or September last year, where he made the bold prediction that silver prices will go to 650 US an ounce before hyperinflation. So now, where do a lot of these price predictions come from? They come from the expectation that the manipulation that we just talked about, it will come to an end. And so for those people who think they are going to make, what I would call generational money, or they will actually make huge profits that will, radically change their life, for that to occur, there needs to be a major breakdown in the manipulation game, or there has to be some significant outbreak of inflation, or some sort of loss of confidence in terms of the financial system. So those are the sort of factors that I look for. Unfortunately, this article that you referred to, that was on Silver Doctors, the issue I have with that is that this particular article, the price predictions were based around technical analysis. Now, technical analysis is basically studying the price movements, whether it's like a 50-day moving average, a 200-day moving average, and then trying to come up with a view as to, given the recent market behavior in the last 3 months, 6 months, 9 months, where do we think that the price is going to go over the next 12 to 24 months? So one of the reasons why, and people who have done this sort of analysis have, they have over the last few years made some big calls about gold and silver going to very sky high in terms of numbers per ounce. The reason why a lot of these people have got these calls wrong in the last few years is because they don't understand that the market is manipulated. So, it's very hard to make predictions of future prices based on recent price movements if those price movements have been controlled by governments, by central banks, by bullion banks, by corrupt exchanges like the LBMA, and in terms of the COMEX. So I don't place a lot of stock on any analysis that does technical analysis, and therefore, the article you referred to in question, I didn't find it to be particularly credible. So when I look at gold and silver, from a more fundamental basis, so there's been a huge amount of money that's been printed and created to date. The central banks are going to be printing more money, and looking at the repo crisis that started in September of 2019, we've seen that the US Federal Reserve pumped in at least $416 billion into the repo market since September, up until about a week ago. So huge amounts of new currency, new credit being created to keep the system afloat. And so when you look at that, when you look at the level of risk, when you look at the potential outbreak for inflation, all of those factors lead me to believe that we will see investors become nervous, investors looking for safety, investors wanting to have exposure to gold and silver, and that should be driving the price up over the next 12 to 24 months. Now, how much will it go up? Hard to know. Last year we had a very good year.
Yeah, I did. I thought you had the crystal ball, John.
Well, I mean, I think it's so. I definitely wish I had the crystal ball. No, obviously we had a good year last year. There's expectations that gold and silver prices will go higher, but there's the establishment, the global elite, they still have control over these prices via these exchanges. So can they keep a lid on prices in 2020? Potentially so. But obviously, one of the key points to make is that if you believe that manipulation will come to an end because they will lose control, or they'll lose control of the market or lose control of these exchanges, that's when you can make the fortune of a lifetime. So just like I said, silver based on fundamental analysis should be roughly around $600 600 an ounce in Australian dollar terms rather than 26. How do we get there? How do we get to that sort of level? Basically we need the manipulation to end. Now, when I've spoken to some of these experts around the world, one of the questions that I continually ask is how, because a lot of people want to know when will the manipulation end. I'm more interested to understand, well, how will the manipulation end? And so far, I haven't come up with a lot of convincing answers. There are definitely different theories have been put out there, some more credible than others, but so far nothing has really captured my imagination that's captured my imagination to date. So what I would say to people is that the fundamentals point to higher gold and silver prices. So particularly if you're wanting to preserve your purchasing power, it definitely makes sense in this environment to have exposure to precious metals, and that's why I've been buying for 3 years, because the behavior of the central banks and the financial system has been quite consistent over the last 3 years. But how much will it go higher in 2020 and 2021? Hard to know, but there definitely is potential for it to be quite large, particularly if we start to see parts of the financial system break down, and we see trouble brewing in terms of the manipulation game.
Yeah, the question comes up so often when I'm discussing with a new client, because most new clients just want your education, and they hear these reports, and I've got to calm them down a bit. But one thing I always do say, and Darryl will agree with this, that we go back to the Egyptian days, we go right through that, we're talking 5,000 years of history, and when you have a look at the 3,800 fiat currencies that have existed, they all average between 40 to 50 years. And 51's the longest I've ever read about. We're only 3 years away, and you can tell right now that the world is in deep strife with all of its debt. So it isn't too far down the track. My next question is one that also comes up because it's frustrating when people are not quite as educated as they could be. But it's a personal thing, and people think, well, maybe this will happen, maybe that would happen. My question is, in your opinion, John, do you believe our clients would be better off waiting for a small correction before the above happens? In other words, they're waiting for maybe a price drop. What do you think? What do you think about that?
In terms of myself, I mean, I've been a consistent buyer of silver, and we probably will get into this later in the interview. But we do have clients that focus more on gold. We have some clients that focus on silver. We have some clients that want a combination of gold and silver. I mean, I personally, because and we'll talk about this soon about the gold to silver ratio, because silver is so cheap compared to gold. I mean, I've mainly been buying silver for about 3 years, and I've been buying consistently over 3 years. So I've been buying at relatively sort of high prices. So prices were a little bit higher in 2017, 2018, and then they dropped in the second half of 2018. So while they were sort of relatively low, I was buying through there, and so I've been effectively dollar cost averaging right throughout the recent price cycle over the last 2 or 3 years. So it's very hard to know exactly how this market will move, particularly because it is heavily controlled and manipulated. So so some people may think that gold and silver prices may take for a dip. Some people may think that prices will go up higher. What I would say is very hard to predict whether prices will come back a bit and by how much and when. All the indications is that they should be going higher because of all the fundamental factors that we just had a discussion about. When we look at the potential for silver, and obviously we mentioned Egon Volgray is saying 650 US an ounce. My calculation says that silver should be 600 Australian dollars per ounce. Keith Neumeyer saying $200 per ounce US. Bill Murphy saying $100 US. And Bill Murphy from GATA. Other people, are saying sort of $80 to $90, etc. So whatever the number that is put out there, every indication is that silver prices will be quite high, particularly as we go into a financial environment that people feel more uneasy about. So so what I would say is I think people shouldn't be worried about if silver prices were to fall 50 cents here or 20 cents there. If you're buying because you want to preserve your purchasing power, particularly because because the market is rigged, and the more important thing to focus on is actually getting hold of physical metal, because once the chaos starts in the financial markets, and there's a big rush towards gold and silver, it's going to be very hard to get your physical hands on it. A lot of people like to focus on, for example, 2008 when the GFC happened, silver prices, gold and silver prices fell quite a bit, in September and October, November of 2008. But even though the prices were lower, it was actually very hard to get physical gold and silver in that particular market because there were shortages. So if there's a loss of confidence, there could be all sorts of shortages that have happened, and you guys may want to share the story that over the last year and a half while I've been working with you guys, we've had a few months here and there where some of our suppliers have said either domestic or internationally that they're struggling to either get enough raw silver or to process enough silver to be able to meet demand, or some of the major customers just want all of the supply, and we've been placed on the back burner. So just because previous behavior says prices may come down a little bit lower, it may not because of the whole issue around manipulation. But the other factor is that, and this is something that Jim Rickards has focused quite heavily about, is while you have the ability to get access to physical gold and silver, get your hands on it, because when the chaos starts and there's a rush towards gold and silver, even though it may be a favorable price, you may not be able to get your hands on it.
Interesting. I remember Peter Daniels used to say to me, when asked the question of when's the right time to buy precious metals, he'd just say, the most important thing to do is get started. Just get started, because once you start, you can add to it. And that's what we found, haven't we, Brian?
Yeah,
absolutely. Over 26 years, thereabouts, we started with Peter. He was the influencer, and then just kept adding to our reserves.
Every month.
Yeah, every month. And so you can imagine what's happened over a 26-year period. So I can only emphasise that, John, that people get started and then they get into a habit, a good savings habit.
Before we move on, just a couple of comments from what you've just said, John. Yes, it's very important. I mean, Darryl and I started in 1997. Silver was $4.50 an ounce, and it's now $30 an ounce. So yeah, we're doing okay. We haven't sold any off. It's still there, and but we're loving it, because the bottom line is that it doesn't matter if the price drops 20 cents. We pick up on that, but if the price goes up and then drops, we bought it on the high, it doesn't matter. It comes back. It comes back.
Absolutely.
Yeah. But the important thing that you just mentioned, another important thing you just mentioned there, was actually getting the metal. Darryl and I know that in 2015, we were trying to get metal out of the United States for our clients here, and there was a period of about 3 months where everybody was trying to get as much as they could, and it wasn't a matter of buying at the right price. You just couldn't get it. So my emphasis here is, while it's cheap, buy as much as you possibly can.
Absolutely. I mean, look, right now, and we experienced this the other day, we've had a number of people who have tried to place orders on us for Perth Mint products. I'm talking mainly Perth Mint kilo bars, only to find out that it's just not available to us or anybody at the moment. We cannot place an order with a Perth Mint on 1 kilo bars, and they haven't advised us yet as to when they'll start taking orders again. So this is really a great example, isn't it?
Exactly.
So you've got to take it while it's there.
Yeah. Moving on, we're going to start looking into what we call the GSR, or the gold to silver ratio pricing. So, John, it looks as though a lot of evidence is indicating that we're about to experience a major breakout. In November of 2018, you wrote an article titled, "Can Physical Silver Change Your Life?" I read it about 5 times. And in that article, you illustrated 5 times between 1980 to 2011, the gold to silver ratio went below 40 to 1, 4 out of 5 times in that period. Presently, it stands at 86 to 1. In your opinion, John, what is the significance of this ratio?
Thank you for the question, Brian. I mean, so I did write an article in November of 2018 about the physical silver market. If people visit my website over the Christmas break in the last few weeks, I did write a new article specifically focused on the gold to silver ratio. So a few points to make on this. First one is that the historical gold to silver ratio, and so David Morgan from the Morgan Report sort of has highlighted this on quite a few occasions, is the historical ratio has been about 15 to 1. There have been societies where it's been 1 to 1, as in when you look at ancient Egypt. If you look at some of the dynasties in China, the gold to silver ratio was roughly about 4 to 1. But the historical average has about been, looking over thousands of years, has been about 15 to 1, and yet we have this issue of a gold to silver ratio of 86 to 1. Now, why is the ratio so abnormally high? It's because of the manipulation, and silver is way more manipulated than gold is, and so that's why we have this huge statistical anomaly in terms of relative gold prices. And if people don't understand what the gold to silver ratio is, it's effectively the gold price divided by the silver price, and you get a relative measure of what the gold price, how many ounces of silver does it take to buy to buy an ounce of gold. And so 1 ounce of gold today is worth about 86 ounces of silver, whereas historically it should be about 15 ounces of silver. So what that says to me is that silver is very cheap, ridiculously cheap compared to gold. And so one of the things that I have long articulated to clients is that if they believe that gold is going to go up in this environment that we've been talking about over the last couple of years with all of the risk and the debt, etc., what will happen is that when gold goes up, historically, silver will go up. This gold to silver ratio will shrink, and customers are likely to see that they'll make greater returns from silver relative to gold. And at the start of this interview, Darryl referred to silver outperforming gold in 2019, and potentially an expectation that was going to happen in terms of 2020 as well. So that's probably the first point I'll make is in terms of how to think about what the gold to silver ratio should be. So there's a variety of ways people have been trying to forecast what a future gold to silver ratio may look like, particularly if the manipulation were to end. So some people have looked back at the historical relationship and said, well, 15 to 1 potentially could happen. And when we look at the gold to silver ratio in 1979, 1980, the gold to silver ratio did get down to 15 to 1. Now, since that time, it hasn't got to those levels. So, there's been various occasions where the gold to silver ratio has got down to like 50 or 40 or 30, but in the last 40 years, it only got down to 15 once. So if the manipulation was to end, it could get to 15 to 1. Keith Neumeyer from First Majestic Silver believes that the ratio could go to 9 to 1 because of the mining output. So when you look at the mining output, for every ounce of gold that's mined, 9 ounces of silver are taken out of the ground. And so people say that based on the mining relationship or the mining output relationship, the ratio should fall somewhere around 9-1. Now, interestingly enough, when you look at the amount of above ground stockpile of gold, physical gold and physical silver, and I took these numbers from the World Gold Council and the Silver Institute. I mean, I calculated a gold to silver ratio of 2.75 to 1, so 2.75 to 1. So I mean, there is quite a bit of silver out there compared to gold. And so if you're doing about, well, how much physical gold is there relative to how much silver there is there that it should be a relationship around 2.75 to 1. So what all this means is, so all of these are different ways to measure this relationship, but I think the key message to say is that a gold to silver ratio of 86-1, it makes no market sense. We have this because of the manipulation that we talked about earlier. Now, we saw in 2019 that the gold to silver ratio reached a level of 93.32, and that happened around halfway through the year. Now, that was a 27-year high. So we have seen in the past where the gold to silver ratio has got above 100. So in theory, the gold to silver ratio could actually get worse than it is now. So gold could go up faster compared to silver. But in terms of what the relationship should be, it should the ratio should be a lot lower than what it is today, meaning that there's a lot more potential to make from silver relative to gold. And this is one of the reasons why I've been focusing on buying silver compared to gold. Now, one of the other things that I will point out is that, and so it's actually a very unique relationship. So in the last in the last 40 years, there's been 5 explicit occasions where we've seen a very sharp decline in the gold to silver ratio. So and all of those occasions where we've seen a very sharp fall in the gold to silver ratio, the silver price has spiked. So the bottom of this ratio has been to the day, basically, or within a couple of days of the silver price spiking. So the gold to silver ratio actually signals a couple of important things. It says to you when silver is cheap relative to gold, and it's a clear signal to buy silver, and that's obviously what we're seeing now in the market. But when the ratio collapses, and this is happening every single time, it means that silver is spiking faster than gold. And so when the gold silver ratio hits its bottom, what that is telling you is that to the day, silver has hit the peak, and roughly around that time, that's when you should be liquidating your silver position. So you can liquidate it in a couple of different ways. You can sell the silver and take fiat to go invest in other asset classes, or spend your money whatever you want. Or when the gold to silver ratio hits its bottom, you can actually convert the silver into gold, and then wait for the gold to silver ratio to start rising again before converting it back to silver. So there's some very unique properties around this gold to silver relationship if you look at the last 40 years in this manipulated market. And again, I wrote a very detailed article, about 2,500 words on this subject, and people can go read the analysis I've put together, and they can do their own statistical analysis using public available data to sort of check my work. But yeah, core message is 86-1 is ridiculous. Silver is dead cheap, and yet I will keep on buying silver no matter if it goes up or down 50 cents here or there, because relative to gold, it makes all the sense of the world to buy silver. And some people said that silver is the cheapest commodity that's actually on the market today.
Yeah, look, that's a great explanation, and I'll comment that silver is the second most used commodity in the world today. So oil is first, and after that, silver is used in so many different areas. That's number 2 on the most used. Last point on that one before Darryl takes over is the fact that the world financial crisis wasn't long ago, 10 years, and the price of silver went down to, as a ratio to gold, 37-1. So it was under half price of gold, and that's what I mean by you can buy twice as much gold if you wait for that ratio to come down to anywhere under 40. Darryl?
Well, we've made a strong reference today a couple of times to how heavily this silver market in particular has been manipulated. But the control over this manipulation has been lost twice since 1971-72. So it does fail, and gold and silver break free in the process. So what I'd like to ask you, John, is what ingredients preempt this inevitable breakout?
Probably a couple of points to make there, Darryl, is so in 1979, 1980, as well as 2011, we saw a partial breakout of silver, particularly silver, but also with gold. Silver got up to, $44 on both occasions. And like we said earlier in the interview, the highest level for silver was actually reached in 1980. So, what happened on those occasions? So you had a few factors that play. Obviously, concern about inflation, concern about money printing, concern about financial risk, concern about the value of whether the US dollar or fiat currency, fiat currency more generally. Those are things to look for, because even though these markets are manipulated through these future derivative contracts, if people are nervous enough, they will go buy these future derivative contracts to push the price higher. And if there's enough demand for these contracts, just like in 2011, it can overpower the ability of the central banks to suppress the price down. Having said that, in 2011, the prices got up to around $44 an ounce in Australian terms, and then control was re-established, and then the price was pushed back down to the current levels that we see today. So that'd be obviously a set of factors that people should look for. The other thing that people should look for is problems with the physical market. If there are shortages, they should also look at if there are any problems in the futures contract itself in terms of the futures market. If there are problems with some of the big counterparties, some of the big banks, some of the central banks who are trading these markets, even the exchanges themselves. If there are some problems with these exchanges, that could signal that the system is losing control, and that prices have the potential to escalate quite quickly. And one of the points that we should make that we haven't made in the interview that we were talking about before we started the interview is when we look at the palladium market. We've seen a dramatic increase in the price of palladium, and in Australian dollar terms, it's above $3,600 per ounce. And the reason why palladium has gone quite ballistic, purely because the derivative manipulation has broken down. There has been some shortages in the palladium market, and there has been a rush to secure enough physical supply through some of these derivative contracts. And we've seen, in the last few weeks, it's like the price curve is quite exponential. So it starts off slowly, and then it goes like a rocket to the moon. And so anyone can look up the price chart for rhodium or palladium. Rhodium is the other sort of big commodity that's being talked about at the moment. And when you look at these price charts and this price behavior, I mean, a lot of people think that if the manipulation, whether it ends in gold and silver, and some people are convinced that it will, we will see price action in gold and silver markets very similar to rhodium and palladium. And the factors I just outlined are some of the factors that whether the ordinary Aussie or particular investors should be looking out for.
Well, it's a very strong point, because we were speaking with Egon just recently, and he said exactly the same thing, that what you're seeing with some of these other metals at the moment, you're going to see with pressure. Well, you're going to see with gold and silver. You will see, and Egon said, you'll see $100 days. So you can imagine what sort of an impact that has on a marketplace. And right now, we've over the last few weeks, we've had $50 days in gold.
The geopolitical event in Iran.
Absolutely, $50 days. So the next step is $75 or $100 day. So we're going to see it there too. So, very exciting times for precious metals holders.
Yeah.
John, thank you so much again. really appreciate your input as always. You put a lot of time and effort into this, and that's what people will get to see. If they go to John's website, they'll find this sort of information there, and there's just so many good editorials there, so much good information all provided free of charge, basically.
A little bit more than what you read in the newspapers.
Absolutely. So, John, thank you so much again. I guess it gets back to what Jim Sinclair says, and we keep getting back to that. And interviewed Jim's partner recently, Bill Holter. But Jim is a billionaire. He owns a couple of gold mines, and says, look, just do what the central banks do. All the major central banks in the world own gold. Why do they own gold or silver? Why do they do that? So that they have power and influence. Keep in mind, they do not want you to have any. A little bit of that was discussed tonight with the cash ban, wasn't it?
Absolutely.
Take away the power from us. They want it all, so they have control. You've got to turn it around and understand how central banks, governments work. And if you may not like it, but it certainly works well for them for a period of time. So do one of the major things they do, and that is take control of your financial life. Precious metals is really the best way and proven way of doing that. Store of value. Until next time, look, other than thanking John for his fine efforts, I would also like to thank our viewers and subscribers.
Absolutely.
Brian, as always, we are just so appreciative of your time. So we would say, until next time, stay well, stay focused, and bye for now.
And bye for now.